Okay, so I recorded this once and it didn't take, so here we go again. All right, so we start this in Part B, paid in capital. So they start off talking about the rights of shareholders, and common shares is one type, preferred shares is another. For common shareholders, unless specifically withheld as a right, they have the following rights. They have the right to vote on matters that come before them. They definitely have a right to every year vote for uh, corporate directors who come up for a revote. They have a right to share in profits if dividends are declared by the board of directors, and they have a right to share in the distribution of assets should the corporation be liquidated. Some common shareholders also have a preemptive right, which simply means that if new shares become available, the current shareholders get to purchase their proportional amount of new shares so that they can maintain their current um, ownership percentage. Now, you can have different types of classes of shares, and each class can have different specified rights. Um, Terminologies are different. And so here you see some of the um types of classifications that happen. Certainly, the most common is common stock and preferred stock, but you can see that the terminology is not exactly the same. You can also have different classes of stock, especially in the uh, common stock area. As far as rights of preferred shares, they have two rights. They have a right if the board of directors declares dividends, the preferred shareholders will receive a dividend before any dividends are paid to common shareholders. We'll see this near the end of this lecture, an example of how that occurs. Preferred shareholders have a preference over common shareholders as far as the distribution of assets in the event the corporation is dissolved as well. Other rights that preferred shareholders might have is a right to conversion. This would be their right to convert their preferred shares to certain number of common shares. Uh, they could have a redemption privilege, which means that the corporation agrees to redeem their shares at a certain pre-specified amount. The preferred shares can be cumulative or non-cumulative. Cumulative simply means that the dividends that are in arrears accumulate and must be paid in a later dividend year before any dividends are paid on common shares. We'll see an example of this at the end of this lecture on cumulative dividends that are in arrears. They can be participating or non-participating. If they're participating, it allows preferred shareholders to receive any additional dividends beyond the stated amount. I think most preferred shares are non-participating though. Uh, so here they ask a question: is uh, preferred stock equity or is it debt? Well, it seems to be a little of both because if you look at them, they're stated at a certain percentage, and so that certain percentage is the amount of interest paid through dividends to the preferred shareholders, but it's certainly a stock, so they can receive dividends. It's debt because the company is obligated to pay cash at a fixed or determinable rate, like I said. And if they're mandatorily redeemable preferred shares, they must be reported in the balance sheet as a liability, not as a shareholder's equity account, because the company is on the hook to redeem these at some future date. Now, the whole concept of par value is a little bit antiquated, as the book points out. Regardless, it's something that accountants need to know how to deal with. Because even though the Model Business Corporation Act has done away with the concept of par value, companies still use it. And so the concept of par value is that the company provides some arbitrary value to each share of stock. It has nothing to do with the market value of the stock, though. And so any amount paid for in excess of par value must go to paid in capital in excess of par. And so here we have an example. Dow Industrial sells 100,000 of its common shares, $1 par per share, for $10 per share. So that's perceived to be the market value. And so $1 million goes to the common stock par value. The other, or excuse me, 1 million's total. And so $100,000 goes to the common stock par value, and the other $900,000 goes to paid in capital in excess of par. Now, if these shares were no par, it would just all go to common stock. So that's much easier to use, is the no par. Sometimes shares are issued for non-cash consideration. And so here you would just try to figure out what the value of the stock is at the time of the transaction. If the stock has no market value, then you would figure out what the value of the non-cash consideration is. So it's the best evidence of the fair value of either the shares or the non-cash consideration, whichever has the best available evidence, and it might require even an appraisal or something like that. So here, DuMont Chemicals issues 1 million of its common shares, $1 par, in exchange for a custom-built factory for which no cash price is available. Today's issue of the Wall Street Journal lists DuMont's stock at $10 per share, and so property, plant, and equipment gets debited for the 10 million, common stock par, $1 par, gets credited for 1 million, and then the paid in excess 9 million. Now, what happens if you issue more than one security for a single price? Well, you use one or the other. Well, normally it would be the value of both types of shares, but if you have just the value of one type of share and not the other, then the second is inferred by being the difference. So we have an example here of that. APMP issues 4 million of its common shares, $1 par value per share, and 4 million of its preferred shares, $10 par for $100 million. Today's issue of Wall Street Journal lists APMP's common at $10 per share. And so that means that 40 million of the 100 million are in common shares. That's 4 million times the $10 per share market value of the common shares. And so for common shares, you're going to list in the 4 million, you're going to list 4 million shares times $1 par per share as common stock, and then the other 36 million of the 40 million is going to be paid in capital in excess. Well, what does that infer about the market price of the? So let's look at that before we go any further. What does that infer about the market value of the preferred shares? Well, if the market value of your common shares were 40 of the 100 million, then you can infer that the value of the preferred stock is 60 million, the remainder. And so here you have $10 par value times 4 million preferred shares. So preferred stock, you credit 40 million, and then the remainder is going to go to paid in capital excess of par for preferred. Now, what happens when you issue stock is you're normally going to have costs involved with issuance of shares, and so the amount that you're going to book is the net cash proceeds from selling the shares, and thus as here you're going to not have the actual selling price, but the net amount of cash proceeds. And so here we have an example of a company that issued, I don't know what the amount is, I think it's like 135 million. See if I can find this in the book. There we go. 136 million. 136.1 million. And so they have these costs, and so they receive net proceeds of 127.6 million. And so that's underwriting costs. And so they're going to book the 127.6 as cash, and whatever is left over is going to be paid in capital excess of par. Now you can have share buybacks. This is where the company buys back shares from existing shareholders they do this as a way to distribute profits to shareholders without the need of paying cash dividends. Also, this decreases the supply of shares in the marketplace, and so that can result in uh, the remaining shares in the marketplace actually increasing in value. Um, Now, the acquisition of a company's own shares does not create an asset. They sometimes and oftentimes, when companies have these bonus situations where they offer stock to employees based upon their performance, um, they have to plan for having enough stock to distribute to these uh, employees. One way to do that is to buy stock back from other shareholders and use those as part of their rewards plan. You can see that there might be other strategic reasons to buy back stocks as well. Stock dividends, a proposed merger, or to defend against a hostile turnover. Now, when shares are bought back, they can be treated two different ways. They can be formally retired, or they can be simply designated as treasury stock. All right, so we have an example here that looks at the treatment of buybacks and doing so as both, um, well, first as a retirement, and then second as a designating it treasury stock. So here we have a company. We've got common stock 100 million shares at $1 par, paid in capital excess of par 900 million. So you've got $1 par value, and then the paid in capital excess of par means that you've got $9 excess of par value per share. You also have a couple of other things here. You've got paid in capital share repurchase from prior repurchases. You also have retained earnings of $2 billion. And so this company reacquires 1 million of its common shares. Well, two things. How they treat this kind of depends, well, it does depend on whether or not it's treated as a retirement or whether it's treated as treasury stock that's going to be resold at a later date. How they treat this also depends on how much they repurchase the stock at. And so in our first example, the company repurchases stock at $7 per share. Now notice in the case of treasury stock, you're simply going to record the cost to a contra equity account called treasury stock. So that's going to be your debit, and of course your credit's going to be to cash. And what you'll see is that the repurchase and later sale of the stock are going to be treated as one transaction once the subsequent resale happens. Okay. Now for a retirement, here you have a situation where you're paying cash per share that's less than the par value and the, well, par value per share, as well as the excess of par per share value. And so the par value per share is $1 per share. The excess of par value per share is $9 per share. Well, it's $10 and you're only paying $7. And so the difference is going to go to something called paid in capital share repurchase. And so that's a plug number, and that's your account that you use if you're paying per share less than the par value plus the excess of par value per share. Now, what happens if you repurchase these for more than the par value per share and the excess of par per share? Well, here we repurchase for $13, and so again, it kind of depends, but what you have. But here, we still have our common stock and paid in capital excess of par of 1 and 9. If you recall, we had a balance in our paid in capital share repurchase at the very beginning before this share repurchase of 2, and that was a credit balance, and so we're simply going to debit paid in capital share repurchase for the 2, and since we're paying cash of 13 and our debits are only 12, we're going to have to take and reduce retained earnings by the difference of 1. Now, what happens if you had no paid in capital share repurchase credit balance at the time of this repurchase? Then, in that case, the whole difference would go to retained earnings by debiting retained earnings for 3 million, not 1 million. Now, for treasury stock, you simply book to the treasury stock contra equity account the cost of the treasury stock of 13 million, and of course credit your cash. Now again, this treasury stocks reviewed as a temporary reduction in the shareholders' equity, and so you temporarily debit your treasury stock account, your contra equity account. The shares are considered to be issued but not outstanding, and so the purchase of the treasury stock and its subsequent resale is considered one transaction. And so you take care of it when you reissue the shares. Now, how do you report the share buyback in the balance sheet? Again, it depends on whether it's a retirement or treasury stock. If they're retired, well, you saw what happens, and here we're reacquiring the 1 million shares at 13. So that's case 2. In the case of a retirement, you're simply going to reduce your common stock by 1 million, your paid in capital by 9 million. You reduced your share repurchase and the excess reduced retained earnings by 1. In treasury stock, we simply create this contra equity account, treasury stock, and report it at cost of $13 million. Well, what if you resell the shares? Well, again, it depends on whether or not those shares were retired or if they're treated as treasury shares. If the shares that are sold were retired, they're recorded exactly like any other shares that are sold. If the resale is of treasury shares, again, it's viewed as a single transaction that was begun when the treasury shares were purchased, and so we have to treat it that way or consider that when we are reselling them. And we'll take a look at how that is done here. And so here in this example, we sell shares for $14 per share. In that first example, you have shares that were retired, and so you treat that just like you would any other share. Here we had 1 million shares sold when its common stock par value was $1 per share, and so you book common stock par value for 1 million shares. The paid in capital excess of par is 13 million, so you debit cash for 14 million. As for treasury stock, you're going to, of course, debit cash. You're going to reduce treasury stock by the 13 million balance that's in there, and then paid in capital share repurchase is going to be the credit for the remainder. Now, what happens if you sell it for less than what you repurchased it for? Well, if it's a retirement, it doesn't matter. You're simply going to book the amount of cash. Here it's $10 million cash received. Since par value is $1 per share, you're going to book common stock par at 1 million, paid in capital excess of par for 9 million. As for treasury stock, you're still going to book the receipt of cash. You're going to credit treasury stock for 13. Since you had a balance in paid in capital share repurchase of 2, you're going to reduce that account from credit balance of 2 down to 0 by debiting paid in capital share repurchase, and then the difference is going to be to retained earnings. Now, if you didn't have any paid in capital share repurchase balance at the time you made this subsequent sale, then you would simply debit retained earnings for the whole 3 million. All right, retained earnings, what is it? Well, for most companies, that amount's going to be a credit balance, which means that you have positive cumulative retained earnings from prior periods. Now, if you have a debit balance, that means that you have prior cumulative losses in retained earnings. Most companies have a credit balance in retained earnings, meaning it's a positive number. But some companies, because of prior earnings, prior losses in prior periods, have a credit, or excuse me, a debit balance. Well, how do they make up the difference to fund their operations? Well, they have lots of stock that they've distributed for cash. And so anyway, if you have a company with a credit balance in retained earnings, that's all their prior period retained earnings not paid out in dividends to shareholders. And so they're available for reinvestment. Now, does it mean the amount in retained earnings indicates the amount that the company can pay out in dividends? No, because that's based upon the amount of cash available to do so. Now, what are dividends? Well, normally dividends are something that the company pays to reward their shareholders. Now, these can be different types of dividends. One type of dividend is what's called a liquidating dividend. That's where the dividend exceeds the balance in retained earnings. Any portion of a dividend not representing a distribution of earnings should be debited to additional paid-in capital. Now, you can have retained earnings restrictions where these are not available for dividends. You would normally just indicate by disclosure notes to the financial statements that a certain amount of the balance of retained earnings is unavailable for dividends because it's being appropriated for other uses. Now, the normal type of dividend you'll see are what's called cash dividends. Corporations have no legal obligations to pay dividends to shareholders, but as a regular practice, most corporations do have a policy of declaring regular dividends because shareholders expect it. And so in order to attract current and future investors, they make a policy of paying regular dividends. But from a legal standpoint, they have no obligation to declare a dividend in any particular year. Because they have no legal obligation to pay a dividend, they're not required to list any liability to pay a dividend until it's declared. When they declare a dividend, the directors, a retained earnings is reduced and a liability is recorded. Now, a listing of all shareholders of record has to be declared or determined. And so normally what they do is have different dates set out. A date of record and something called an ex-dividend date. Now, the date of record is a specified date as to when the determination will be made of the recipients of the dividends, meaning if you are a registered owner at this date, you're going to receive the dividend. In order to give the record keeper time to figure out who the owners are at the date of record, they also have a cutoff date called the ex-dividend date. That's usually a couple of days ahead of the date of record. And so as far as the entries that are made, here we have an example. On June 1, the Board of Directors of Kraft Industries declares a cash dividend of $2 per share on its 100 million shares payable to shareholders of record June 15 to be paid July 1. And so on June 1, they're going to debit retained earnings and credit cash dividends payable. Now on the ex-dividend date, which would be 2 days before June 15, nothing happens, nor does anything happen on the record date or date of record. And then on July 1st, the company pays each shareholder of record as of June 15 their portion of the cash dividends. Now, we talked earlier about preferred dividends sometimes being cumulative, and so here's an example of that and how that would affect the payment of dividends to common shareholders. And so in this example, you have this company, Corbin Enterprises. They have common stock of 3 million paid in capital excess of par common 9.8 million. Preferred stock here is 6 million, and it's preferred stock at 8%. Okay, what that means is that the company pays interest of 8% on that $6 million. It doesn't pay interest on the excess of par, only the $6 million, the par. And so in this case, the board of directors declared dividends of $360,000, $500,000, and $700,000 in its first 3 years of operation, which are 2017, 18, and 19. And so here we have to determine the amount of dividends to be paid to the preferred and common shareholders in each of those 3 years, assuming that the preferred stock is cumulative and non-participating. And the main thing here is the fact that it's cumulative. All right, so what that means is every year that a dividend is declared, they've got to pay 6 million times 8%, or $480,000 to the preferred shareholders before common shareholders get anything. And if there's any amount that's not paid to the preferred shareholders, that excess amount rolls until it is paid in subsequent years. And so, for example, in that first year, the board of directors declared a dividend of $360,000. Well, the amount to be paid to preferred shareholders in that first year is $480,000, the 6 million times 8%. And so there's a deficit there of $120,000. And so the preferred shareholders get all of the $360,000. $120,000 rolls to the next year to be paid, and the common shareholders get nothing in 2017. Now, in 2018, they declare a $500,000 dividend. Another $480,000 accrues that must be paid to the preferred shareholders. And so 500,000 is paid, 480,000 goes to pay the current year. The 20,000 satisfies 20,000 of the 120,000 owed from the prior year, so they still owe $100,000 from the prior year. And so that rolls to 2019. And so in 2019, the board declares $700,000 in dividends. Well, another 480,000 accrues in 2019, so that has to be paid along with the excess of 100,000 not already paid. So the preferred shareholders get $580,000, so they're completely satisfied at this point for 2019 and all prior years. And so the excess, 700 minus 580, or 120,000, goes to the common shareholders. So that's how that works. Property dividends, you can get those sometimes. Not very often. Should be recorded at fair value. Many times you'll see what's called stock dividends. These things are totally worthless. It does not change the shareholders' proportional interest in the firm. It's a feel-good thing, just meant to make the shareholders feel like they got something of value when they really get nothing. So they just get more shares, but the example is, well, if you cut a pizza into more slices, it doesn't mean you get more pizza, it just means you get more slices, right? Well, same here. Just because you get more shares, everybody gets more shares, doesn't mean you own more, any more proportional amount of stock. But anyway, how you treat this, at least under the current rules, is the following. Kraft declares and distributes 10% common stock dividend. That's 10 million shares when the market value of $1 par common stock is $12 per share. So they're going to take the 10 million shares times $12 per share, 120 million, reduce retained earnings by debiting retained earnings for 120 million, credit common stock 10 million times $1 par value, or 10 million to common stock par value, and then the remainder of 110 million goes to paid in capital excess of par. But you're basically just shuffling accounts around. You're removing it from retained earnings and putting it in another equity account. Now, as you can imagine, since you now have more shares, if the shares are sold on a stock exchange, the market price per share will decline in proportion to the increase in the number of shares distributed. And they talk about whether or not they really should do anything. Sometimes you can get what's called a stock split, and so this induces a per share market decline. And so companies do this to when the market value of the per share is too perceived to be too high. And so Microsoft, some years back, when their market value of stock was um, somewhere around over $100 per share, did a stock split so that basically they doubled the amount of shares, reducing the market value per share to half of that. And the reason why they did this is because they wanted the stock to be more marketable to average potential shareholders. So we have an example here. Um, After a company declares a 100% stock dividend on 100 million shares with a per share market price of $12, it then has 200 million shares, each with an approximate market value of $6 million or $6 per share. So here, the accounting treatment of a stock split is to make no journal entry. Probably should be that way for a treasury or a stock dividend, but for some reason they treat it differently. So, all you would do is the par value would be reduced by 1/2 is all you would do. All right, so I think that's all I wanted to go over. Let me look. Yeah, that's it. All right, so I'll put an assignment out there for chapter 18 here shortly.